Hello, everyone. It's time to start if we have any chance of getting through all this material. Welcome to preparing for the 2019 proxy season. I'm Cam Hoang. I'm here with my colleagues Kimberley Anderson, Mike Voves, and Nicole Strydom. We have a really full agenda today, so buckle your seatbelts, look for the emergency exits. We're going to be flying. So let's just jump right into proxy trends you need to know for this upcoming year. You know, companies are continuing to work on their transparency on board composition and board functions. So they're expanding disclosure around processes for board refreshment, the director skills matrix, ESG issues, risk management, pay for performance. But take the advice that your mom would give you. Don't do it just because everyone else is doing it. You know, really be sensitive to what's useful and important for your investors and your audience. And so your institutionals, your board, your management may want to disclose practices that demonstrate that your board is sophisticated and that it has incorporated state-of-the-art practices. For your less sophisticated retail investors and for third parties, they may be wondering what your board does, period. And so a more basic form of disclosure might be relevant. And it's also good to keep in mind that the SEC is factoring in board assessments on social policy issues as it considers which shareholder proposals may be excluded. And so proxy disclosure can lay the groundwork for future proposals. And speaking of shareholder proposals, ESG is a big topic these days. And if your company doesn't control its ESG story, then others will. And so as we're looking at disclosure these days, we're not just looking at what's going into the SEC filings. We're looking at websites. We're looking at related disclosure through social media, because the opportunity for companies to communicate their story and in turn have others communicate their story through these other media is just so much more expanded and it's just so much faster. And so there can be benefits, but there can also be potential liability. And it's not just securities laws. You know, the FTC has brought enforcement actions against Volkswagen for its clean diesel claims. In a recent case, Ramirez versus Exxon, a district court refused to dismiss a securities fraud claim that was based on Exxon's risk disclosure on future greenhouse gas regulation liabilities. So we really are looking at a new world in terms of how information is disseminated and what counts as disclosure that we really need to pay attention to. We are seeing expanded ESG disclosure in proxy filings, and so we're seeing evolving board and committee responsibilities for ESG. Many of you have seen trends on human capital management, and that's transforming how compensation committees are doing their work and really even whether they're called compensation committees. These days, more and more they're called HR committees or talent and development committees. There's more robust responses to ESG shareholder proposals, separate sections on ESG initiatives, and we'll be providing some examples in our supplemental materials that we will be circulating to you after the presentation. And some companies are even including links and QR codes to social responsibility reports. But once again, please keep in mind, we need to be careful because false disclosure draws enforcement claims and fraud claims. We've included a few disclosure trends here for your consideration. So proxy summaries continue to be prevalent and trending upwards. More and more people just want to take a look at a few pages in front of the document and get a global sense for what's in the rest of it and then dive down as needed. A trend that surprised us a little bit is that the use of pay for performance graphics has leveled off a little bit. And this may very well be because companies are sensitive about how these pay for performance graphics will look year to year as performance fluctuates.
Moving on to scale disclosure for more smaller reporting companies. So in June of this year, the SEC announced an expansion of the definition of smaller reporting company. The definition has changed such that the public float of less than 75 million has been increased significantly to a public float of less than 250 million. Revenues went from less than 50 million of annual revenues and no public float to less than 100 million of annual revenues and no public float, or public float of less than 700 million. The scale disclosure requirements for smaller reporting companies are desirable because they permit an issuer to include less extensive narrative disclosure, and particularly in the description of executive compensation. They also allow a smaller reporting company to provide audited financial statements for 2 fiscal years as opposed to 3.
You know, while we're on this topic, the one nice thing about having such a big increase some of our clients are kind of float around right on the cusp of being, whether or not they were accelerated. And so many times they were just under, but because they were concerned about, going over, they would use the more fulsome disclosure and not use the smaller reporting company standards. Now that the thresholds are so much higher, at least with one of our clients, we're going to be sitting down to go through those differences because they're going to be more comfortable that on a year-to-year basis, they are going to be very safely still a smaller reporting company, so they're not going to have to do dramatic changes to their disclosure. Oh, one thing, being a smaller reporting company, it's not all less disclosure. Related party transactions are 2 years and not one. So there are some things that are bigger, but it's really not much.
And in keeping with this, alleviating some of the disclosure requirements, I think in general, the expansion of the definition of smaller reporting companies is part of the overall theme of the SEC, where they're trying to encourage more companies to go public. This was further evidenced by the fact that about 2 weeks ago, the SEC published quite a long list of rules to be reviewed under their Regulation Flexibility Act, and that agenda does include some items that may affect future SEC disclosures, including executive and director compensation. They're going to be looking at some of their 2006 amendments and rethinking those, shareholder proposals relating to the election of directors, a number of access-related items, proxy disclosure enhancements, including board leadership, compensation consultants, and board oversight of risk. Although notably, this list does not include the elimination of 10 Qs for smaller reporting companies. And this may eventually end up being proposed based on some previous comments made by the CorpFin director, although Kimberley thinks decidedly not.
No, it's not going to happen.
Also, CorpFin updated 4 C and DIs to address the impact of changes in size thresholds. I'll just run through some of these quickly. Under Regulation SK, item 102.01, that one explains how an issuer can be both an SRC and an accelerated filer. 102.02 clarifies when a company that does not qualify as a smaller reporting company in a particular year will be able to qualify if its public float or annual revenues later decreases. Another one, 202.01, confirming that when calculating annual revenues to make a smaller reporting company determination, the issuer should include all annual revenues on a consolidated basis. One more, under the Exchange Act forms, that one explains when an issuer is allowed to continue to use smaller reporting company disclosure in a limbo period when the issuer is on the cusp of no longer qualifying for SRC status.
Yeah, so this came up in a recent filing. If you can be, as she noted, both an accelerated filer and a smaller reporting company at the same time, check both boxes, and then make sure you include your auditor attestation because you are not yet out of it until they change the rules. So if you check the accelerated filer box, you don't get out of it just because you're a smaller reporting company because now you can actually be both.
Although the SEC staff is working on a rule that would reduce the number of accelerated filers that have to get that auditor attestation.
Until you know the rule's been
Yes.
passed. All right, so in mid-November, the SEC had a proxy process roundtable. This was a chance to get a number of panelists together to talk about, and they come from industry, activists, companies, et cetera, to talk about some, this year there were 3 main panels. The first one, and frankly, by far the most important, is going to be proxy voting mechanics. As you know, anybody who has to figure out, how votes are counted realizes how opaque ownership is. So, because there was always a concern about accurate vote counting. It used to be there were significant more overvotes, meaning that there were far more votes than you actually have shares. That has decreased, but the Securities Transfer Association thinks that they haven't solved the problem. The service providers are simply capping the number of votes that they'll report. That also leads to the issue of vote confirmation. Many investors want to say, well, did you get my vote? Can you confirm that you got my vote? Based on the current situation, it's very difficult to do that. So, in terms of sort of the basic proxy plumbing, just the way the securities market is set up as to how shares are held makes this very difficult, makes shareholder engagement more difficult. And then they also noted declining retail shareholder participation. I will note that despite the fact that I review these on an annual basis, I have only ever voted once, and that's when I was very, very, very unhappy with the stock price. So And then there is actually, surprisingly enough, a bit of an increased interest in the universal proxy. A universal proxy is when you have, in a contested election, you would have all of the nominees from both the dissident slate and the company slate on one proxy. It makes it easier for a shareholder to kind of pick and choose. And it more closely replicates what they'd be able to do if they actually showed up at the meeting, because otherwise you have to pick your proxy statement. So the objection from companies seems to be decreasing a bit. And then there's the theory that, blockchain will answer everything, because of course it's the universal solution. But, we'll see, but they're looking at technology. Shareholder proposals, concerns about eligibility thresholds, as to whether or not you get someone with a very, very low threshold being able to push proposals or bring proposals back on a repeated basis. It was legitimately commented that, a number of things that are now sort of set and accepted corporate governance started as sort of, small shareholder proposals and built over time. And then on the proxy advisory firms, anyway, the biggest concern was the opportunity. While I consider them slightly on par with the evil empire, I'm really not concerned about actually their registration. But there was some considered interest in an opportunity to correct the record in case, in someone's review, there are mistakes made and errors made. That, I think, really goes to the issue of when you're drafting your proxy, make sure it's very clear what you want people to see. So we'll be talking about that more in a few minutes.
So debriefing from year one of the CEO pay ratio, overall, the ratio numbers weren't as large as people feared that they would be. There was an average of 144 to 1. And not surprisingly, what industry you're in really influences your ratio. So if you're a retailer, you're talking about in the hundreds, but those in the finance and utilities industries, we're looking at ratios 59 to 80 to 1. And also not surprisingly, there was a close correlation between the size of the pay ratio and revenue. About 25% of companies took advantage of the exemption for up to 5% of non-US employees. And so looking back at this year, I'm curious, Kimberley, did you see, or did any of our clients see a backlash among employees or the media based on the pay ratio disclosure?
While I spoke with a number of our clients regarding their concerns about how they were going to be describing things and how they were going to be disclosing things, I have not heard of a backlash. And in fact, it doesn't feel like there was as much froth and fluff about CEO pay ratios than I was expecting.
Yeah, it seemed pretty subdued. I don't know if anyone in the audience wants to weigh in. Something that people are starting to talk about is now that there is this system in place for calculating pay ratios, that activists will be looking for gender pay ratios because they'll say, hey,
But that actually has
you guys
meaning.
can do that.
The CEO pay ratio is an utterly meaningless number.
Yeah. Hey, I'm not going to argue with that one.
Okay.
No way. So pay ratio in year two. The SEC has come up with a wonderfully definite standard for whether or not you continue to use the median employee that you identified in the first year. So if the employee population or employee compensation arrangements that the company reasonably believes would result in a significant change in the pay ratio disclosure, if there's such a change, then yes, you do have to re-identify your median employee. Furthermore, if that median employee circumstances have changed, so that the company reasonably believes that its pay ratio disclosure would significantly change, then you could sub in another employee and just explain that. But in any case, if you're using the same median employee that you used for the first year, then you do have to briefly disclose the basis for your conclusion that you may continue to do so. And we've included a pay ratio checklist in our supplemental materials that you may find useful for your reference.
So you can see from this slide that the say on pay support did falter a bit, falling from 92.6% in 2017 to 91.2% in 2018. And this declining support marks a departure from the upward trajectory in say on pay voting starting in 2015. As one might assume, a critical driver of shareholder support for executive comp is the issuer's economic performance. And you can see in that quote under the CalPERS bullet that they're looking at pay or performance over the long haul. A study from the University of Pennsylvania showed that if stock price performance was strong, even firms in the highest quartile of excess CEO pay received only 11.4% votes against, whereas votes almost doubled against for issuers with the same level of excess pay but that were in the lowest performance quartile. It's not really a surprising result. One item of interest with regard to say on pay, which kind of goes to the point of that people don't really know what they're looking at, they don't really necessarily care as much, is that shareholder support for say on pay proposals at companies where the CEO pay ratio was disclosed was virtually the same as at companies where the pay ratio was not disclosed. Moving on to the next slide, just a brief reminder for say on frequency, if you're a smaller reporting company, if your last vote was in 2013, you will need to do it this coming season. All right.
Okay, shifting now to tax, I want to talk a little bit about some changes under tax reform, or specifically the Tax Cuts and Jobs Act, that will, if it hasn't already, impact to a certain degree your proxy process as well as some of your executive and equity compensation practices. So a little bit of background here. Section 162M is a provision in the tax code that, together with the underlying regulations, places a limit on a deduction limit on compensation that is paid to certain named executive officers. Prior to the tax reform, and this is specific to public companies, by the way, prior to tax reform, there had been a significant exemption to the deduction limit for performance-based compensation. And in order to qualify as performance-based compensation, generally you had to have a certain process by which you established and administered performance-based pay and then had it approved by a committee composed of outside directors, and it had to have sufficiently objective performance criteria, et cetera, et cetera. This is all changed now as a result of tax reform. That exemption has been repealed, essentially, and now all compensation, regardless of its form, whether it's a stock option, a performance share unit, a restricted stock unit, whether it's performance-based, time-based, whether it's cash or equity, it's all analyzed now under the same flat deduction limit. There's some other things worth discussing here too, very briefly, but they're not necessarily going to be germane to our proxy process discussion today. But the tax reform legislation also expanded the scope of which named executive officers are covered. Previously, due to what I would call a glitch as a result of a kind of an inconsistency between the tax code and the SEC's proxy rules, the CFO had been excluded from this limitation, and now this loophole has been corrected. Another change, which really wasn't a loophole, but was viewed very negatively by many people, was that the prior 162M rules only applied to actively employed executives. And so once an executive either terminated during a taxable year or moved to some other non-NEO role, like they could essentially then fall out of the 162M deduction limitation. And so the new rule now is once a covered employee, always a covered employee. The tax reform also expanded the definition of what is a publicly traded corporation, by the way, and there's some interesting things there that now would pick up companies that now have to register not just equity securities, but other types of securities that may need to be registered, and as well as certain companies that are required to make certain filings under, what is it, Section 15?
Yes.
Okay, and
Very
so an expansion there, but not necessarily germane to our discussion today. And then finally, and we'll get into this, there are arrangements that may have already been in place prior to this enactment of tax reform that are grandfathered from the new rules and subject to the old rules. So let's move to the next slide. Okay. So now, how does this impact your processes? Well, for many public companies, you have or maintain an equity incentive plan that is shareholder approved. And if you're familiar with the process for designing the plan and getting it approved, usually there are specific provisions in the plan that speak to performance-based compensation. It's not uncommon that you would have a laundry list of objective performance criteria, and as well as certain limits around what what people can receive in a given year in terms of equity awards. And whether you knew it or not, a lot of that was driven by 162M requirements. And those requirements are no longer applicable. And so while I'm not here to suggest you should abandon using performance-based compensation or that you should materially change your performance-based pay practices, nor am I suggesting you immediately go out and amend your plans necessarily, but you should think about when your plan comes up for reapproval, whether you still really need a lot of the specific performance-based, shareholder-approved performance criteria, because it's no longer necessary and it doesn't get you any extra tax deduction.
So Mike and Kimberly, just let me interrupt here. Are you seeing companies implement design changes immediately because of these reforms?
I have not. I think companies many times are loath to go to the well more often than they need to. If at a time when they need more shares, or they're just deciding to adopt a whole new structure, that you might see this, but I have not seen any of our clients, I'm not saying that they don't exist, I just haven't worked with them, that are going out simply to remove some of these limitations. So that's not something I've noticed, but it wouldn't surprise me over time as plans get amended, either add more shares or they decide to adopt new plans as trends change, that a number of these things would come out. But have you seen anything?
Yeah, and so aside from plans and getting plans approved and sort of visiting your provisions as it comes up for reapproval, it's getting to actual just sort of recurring practices like annual incentive plans, long-term incentive programs. I have seen companies now start to abandon this. Again, for those of you that are familiar with 162M, there are specific requirements you had to have in order, like specifically objective performance criteria. The committees that administered these arrangements were prohibited from exercising discretion to change the performance criteria in the middle of a performance cycle, except they could do it negatively, meaning they could ratchet down, they could take away, but they could not do things to increase. We are seeing now companies kind of loosen up a little bit and saying, look, if it doesn't make a difference, if I'm not going to get the tax deduction regardless of whether I exercise positive or negative discretion, then I'm not going to do all these gymnastics to write in here that I will not make adjustments for this or not make adjustments for that. So we're seeing now plans being written maybe a little bit more flexibly, but it's not on the whole changing their philosophy about performance-based pay.
Right. If your committee comes to you and says, we would really like to start doing both positive and negative adjustments, make sure you check the plan first.
Yes.
Many of the plans have that negative discretion built in there. That would also go to, and we're going to talk about, one of the reasons we have Mike here is that we're going to be talking about when you're getting plans approved and the disclosure, and we're going to be talking about that in a few minutes. But also a requirement that many people have 162M outstanding securities. And keep in mind, when you're putting together your committee, which already exists, just because sort of 162M is eased up on some things, you still need to make sure that your outstanding awards,
Grandfathered awards.
the
Yeah,
grandfathered
exactly.
awards, before they can be certified, that committee still has to comply. So don't run out and make a bunch of changes to add someone back on that previously would not have been allowed unless you don't have any grandfathered awards.
Yeah, that's a really excellent point. Maybe we can move to the next one.
Move the next one?
Yeah.
Here we go.
So again, grandfathering, it's important to emphasize that the new law technically doesn't apply to arrangements that were already, binding and in effect prior to, I believe it was like November 2nd, 2017. The IRS did issue some guidance earlier this year in August that, to be frank, was almost entirely negative. It essentially came out and said, among other things, suppose you have a contract or a plan that was in effect before the tax reform was enacted, but it gives your committee negative discretion, like carte blanche negative discretion, to reduce the payout of any award down to nothing. And the IRS or actually I guess it was the Treasury's, in their eyes, that's not a legally binding contract to anything, so that nothing there is grandfathered. So that's an important point, because to your point, a lot of these plans, a lot of these arrangements, particularly annual incentive plans, particularly long-term incentive arrangements, do rather sneakily somewhere in there reserve some kind of discretion usually, negative to pay, to reduce the compensation. And so if that's the case, you probably don't have grandfather where you might have thought you did. Another situation is where maybe there's compensation payable under an employment agreement, and that employment agreement either expires or even is automatically renewed. Once it's automatically renewed or expired, it's no longer grandfathered. So those are important things. So again, to tying it back to this topic, today's theme is, well, how does this impact your proxy process? How does it impact your disclosure? Well, in a couple different ways. First is I wouldn't be surprised if I went through and looked at any of your proxy disclosures that somewhere in there, and I'm paraphrasing here, it says something to the effect of, we will make reasonable efforts to design and structure compensation that is fully deductible, consistent with 162M, but we do reserve the right where appropriate to not do that. And I would ask you to think about that now, because frankly, under, in a post-tax reform world, it's pretty hard to structure compensation that is fully deductible, unless you're gonna cut executive pay. So you maybe want to.
So you may not want to make that
You
statement.
may not want to make that statement. You may want to think more carefully about what you're saying and about how you're structuring your compensation.
Yeah. And that really also goes to when we're talking about approving a new plan. Because tax effects are always there, and 162M is typically discussed. And so you need to make sure that you don't sort of just recycle old disclosure, not suggesting that any of you would do that. But nonetheless, make sure that that is something that you consider carefully as you're going through and looking at the plan design itself. And then we'll come back to that in a moment when it comes to compensation plan proposals. But we wanted to touch briefly on director compensation limits. So generally speaking, director compensation limits have been increasing. This is limits on their, generally speaking, their equity awards, or sometimes it's a combination of a limit on both stock and cash versus just stock. In fact, I guess 32% now have a combined limit on the two, and that's up from 29% last year. And 61% now have limits on their compensation, which is 17 more companies increased, so it also increased. But this is an increasing trend. Part of it's due to some shareholder lawsuits, what can best be described as sort of egregious, it's the pigs get fat and hogs get slaughtered concept. But so you need to be careful about that. But some of these issues of putting in limits is both a matter of both governance as well as a protection against liability. And so they're building in these limits, sometimes in shareholder approved plans. But we are seeing more and more moving away from stock options. Only 7% of the 300 companies from the Fortune 500, only 7% use stock options. I think some of the smaller companies have a greater reliance on stock options. I'm talking with a couple of our clients now about moving away from stock options toward more of a deferred share unit. But that is an increasing trend. Shareholders don't like stock options. And so, that trend is continuing. And an average pay mix recently has been about 43% cash, 57% equity. And right now, restricted stock is the preferred form of equity. So, that's the sort of a general discussion on director compensation limits. Have you talked when you have been designing plans with our clients, do they tend to build more limits into plans now?
Oh, absolutely, absolutely. And that is largely as a result of the shareholder litigation that you kind of referred to. And so as you said, the facts of some of those cases start with just excessive compensation. But inevitably what happens is the legal arguments delve around, well, what is the board's sort of, how are they going to be judged? By a deferential standard of review or by something more onerous and more difficult? And of course, when you have a conflict of interest, which is inherently the case with non-employee director compensation, because there's not an independent layer of review, courts seem to be saying now, well, we're not going to give you a deferential standard of review. So then the clients come to us and say, well, do we need to specify more limits? And if you wanted to take it to its extreme to eliminate that risk of being second-guessed under an onerous standard of review, you would essentially put a very specific self-executing formula in your stock plan and send it to the shareholders for review. But in doing so, you would, to some extent, hamstring yourself. You would lose some flexibility. So if you want to reserve some flexibility and some discretion as to how you're going to set director compensation, you're going to have to live with some risk that somebody could second guess that and make a claim that somehow that's not best practice or excessive.
Yeah, I mean, I think it really comes down to a risk assessment, which, and so when you are looking at, because the shareholder litigation, they were terrible, terrible facts. So I think it really comes down to, you know, how much are your directors being paid? What does it look like compared to your competitors?
Yeah.
You know, how are you benchmarked? How is the company performing? So, you know, it's, you know, having more flexibility, I guess in my view, I prefer it. I think the board should have more flexibility, but sort of a real limit, a meaningful limit, I think is still very useful. And then frankly, also just, there is a certain amount of common sense here.
Yeah, and so, you know, we would, at least I would advocate for now, and it's becoming a standard practice, which is in your shareholder-approved stock incentive plans. Whereas 10 years ago, you probably wouldn't have seen a specific director limit, or if you did, it was more of like a percentage of the overall share reserve. Now you're seeing a very specific, usually but not always a dollar value limit, saying that, look, directors annually cannot receive stock or sometimes stock cash in excess of X value. And of course, then you have to use a standard like a Black-Scholes method in order to say, okay, what does that come to
Yeah,
in shares?
And what's the trend there, Mike? Is the limit on just stock or is it on overall compensation?
Well, you know, I definitely see compensation consultants are now saying you should consider both unlimited compensation, but I think it gets back to that same point which is, look, you're not gonna be able to eliminate completely the risk of somebody second guessing or challenging you unless you literally hardwire everything into your shareholder approved plan and have a self-executing formula. So, you know, I would say it's still more commonplace to see a dollar value limit applied to equity awards and not always covering cash compensation, but I would concede I'm seeing that more and more now.
So, we did want to talk about
Yeah, a little bit about-
compensation plan proposals, and then I'm going to intercede on this one.
Right. So the SEC staff did issue a series of C&DIs regarding proxy roles and more specifically, item 10 of Schedule 14A, which states the disclosure requirements for compensation plans that are submitted for shareholder approval. And one of the more substantive changes that we wanted to highlight is found in C&DI 161.03 relating to the new plan benefits table. Previously, the SEC's telephone interpretation stated that when a new plan benefits table was required, all of the various individuals and groups needed to be listed, even if the amount to report it for them was zero. This new guidance doesn't get rid of that table altogether, which is, I'm sure, what most issuers wanted, but it does at least provide more flexibility in that you can now leave off those folks who are going to be listed as zero and disclose them in a narrative form if you choose.
Yeah, so, I mean, one of the points that I wanted to highlight is, particularly when you're looking for either, you know, an amendment to your plan where you're simply adding more shares to it. I think that's many times the one that always concerns me the most, is because many of the times there's a temptation to pull your original summary. Gosh, we're just, you know, adding something to it. You do need to discuss the whole plan. You can't just say, look, it's our previous plan. You've seen it and approved it. Now we're just adding another 1 million shares to it. Thank you very much.
Yeah.
Go ahead.
Well, I was gonna say, I mean, you're also risking that someone, and this is realistic, that someone misreads your plan,
Yeah.
right? Unless you take some time now to add a little summary at the beginning that says, hey, look at the good things we do.
Yeah.
We don't allow for recycling of shares liberally. We don't allow for discounted stock options, and there's a whole litany of things. But now it's good to just say those up front.
Yeah, it's, on the compensation plan proposals, you know, right now, the proxy statement, Cam's gave me the evil eye. She told me she'd cut me off at 40. But when you're dealing with a compensation plan proposal, regarded in many ways as designing your CDNA, Because keep in mind, this is a binding proposal. Unlike, say on pay, which is you always want a nice result, et cetera, this one actually makes a difference as to what you can do. So when you're thinking about it, both keep in mind comments regarding 162M, because those will come up because you have to include the tax disclosure. I know our tax lawyers always prefer more than 30 minutes notice when you're going to ask them for a review. So keep that in mind. But, consider this in many ways, marketing piece sounds wrong. And I don't mean it that way. It's not fluff. It's actually helping to both the proxy advisors, your major shareholders, your retail investors. This gives you another chance to highlight some of the terms. Is it a double trigger? Does it, no discounted options? Some of these things are obvious points, but it is useful to have them out there as a summary so someone doesn't have to read through a very, very dense, legalistic description of the material terms. So in many ways, you might want to, it's rare that I say this, you're actually going to be extending disclosure. I think most disclosure is too long anyway, but in this case, I think the summary and the chart, when I was a first-year associate, the partner told me, he said, I like bullet points and monosyllabic words. I'm not going to limit you to single-syllable words. However, bullet points and charts outlining the salient features, include your burn rate, always important to include it, highlight director limits, and make these easy upfront, and most importantly, make sure they're correct. So don't take somebody else's chart because you like it and don't forget to update it. Always make sure you double check your data. But it is something that you really consider this is a very important plan proposal. I think it doesn't always get as much attention as it should. And so that's one of the reasons we wanted to highlight it today, and which is one of the reasons we asked, Mike to join us today.
Yeah. Well, thank you so much. Now, we do have some sections in here about shareholder proposal trends and developments. We're going to skip that for this session. I'd encourage you to check out our webinar on this that's archived on the Dorsey website. And also, there are some developments in ISS and Glass-Lewis voting policies that are definitely worth a look, particularly with regards to board gender diversity. But we're going to skip over that right now. So moving on to our short hit list for trending issues as companies are looking at updating their risk factors and MD&A disclosure. We're seeing issues that are impacting across industries such as trade policy. So the renegotiation of NAFTA, the impact of tariffs on goods imported and exported through the EU and China. And obviously, tax reform is having a big impact across a wide range of businesses. In a recent U.S. Supreme Court decision, South Dakota versus Wayfair, there was a holding that the physical presence in a state was not necessary to create taxable nexus for sales and use tax purposes for businesses. And so for those companies that have any involvement in e-commerce, this is something to track and to consider for your disclosure purposes. A couple of the bullet points that we put in here at the end, cybersecurity and data privacy compliance, environmental compliance and regulatory compliance. They're here because companies have recently been sued because the disclosure that they gave with regard to their compliance on applicable regulations and on risk was a little bit different from what the investors were seeing. And so definitely areas that people will want to visit.
And if you do business in foreign countries, and there have been either if it's major political legislative changes in the regime and so on, make sure you are keeping those updated. It's very, very easy for risk factors to get stale. If the top 10 risk factors in your 10K do not correlate with the top 10 things keeping your CEO and CFO up at night, I think you should either consider reordering them or add more in there. But anyway, they're incredibly boring to read and incredibly useful and protective for you.
Yes, they are. In fact, if there's ever a debate about whether or not to disclose a risk factor, as a lawyer, we would say yes. You want that risk factor in there. In the real world, we also have to be prepared for questions about, well, then how is your company mitigating against that risk, right? So we've included a few drafting tips in here. I'm not going to go through all of them. One that's particularly fresh for this year is that often an abstract discussion of a risk is not sufficient if a specific risk has materialized. And we saw this play out with the Yahoo's SEC settlement, where the SEC pointed out, hey, you had clear and material instances of security breaches. You didn't disclose them in your risk factor. So something to consider there. In terms of SEC comment letter trends, it's a continuation from last year. So, as we know, the SEC reviews each registrant at least once every 3 years. And then they do tend to focus on the larger issuers. And so 84% of comment letters in 2018 were received by accelerated filers. In terms of trends for comment letters in the coming year, what we're going to see is a focus on accounting under new accounting standards, so revenue recognition, leases and credit impairment, disclosures about cybersecurity, and accounting for income tax reform. And in particular, when we're looking at revenue recognition, we're going to see the identification of performance obligations and the application of principal versus agent guidance as a frequent topic for comment, as cited by the Office of the Chief Accountant. And here, courtesy of E&Y, a really useful rundown of the top 10 most frequent areas of SEC comment over the past year. And so MD&A has consistently been in the top tier over the past several years. And they give some interesting color as to what specifically in the MD&A is getting attention, including results of operations and critical accounting policies and estimates.
So over the past year, we've also seen some disclosure simplification rules come out, and ironically, one of the main changes as a result of the so-called disclosure simplification requires more disclosure, not less. So previously, issuers were required to present a statement of changes in shareholders' equity and disclose the amount of dividends for each class of shares annually. They now must do so quarterly. However, the SEC staff did at least clarify in a C&DI that it wouldn't object if the issuer's first presentation of these changes in shareholders' equity didn't appear until the quarter beginning after November 5th, which means that if your company's fiscal year ends in June, at the end of June or at the end of December, you don't need to include this until the 10Q filed for the quarter ended March 31st, 2019. A number of other changes to existing requirements were also made under these disclosure simplification rules, and they're intended to clarify the auditor's role and responsibilities and make the auditor's report easier to read. But I think, Kimberly, you wanted to talk a little bit more about this change in shareholders' equity matter.
I think you actually adequately covered it. Really what it comes down to is to make sure that you do anticipate it. It's going to be coming up rapidly. It won't be part of obviously your 10K or your proxy, so we won't be spending too much time here. I think most public companies, the finance department have a good grip on this, but it is going to be one of the changes. So particularly for some of our smaller reporting companies and so on, it might be useful to think about and kind of put on your calendar of something to do when they're putting together their first quarter. So, critical audit matters. This is mostly, it's a reminder. We went through this last year. Last year, as you know, there were changes made to the auditor report. In fact, the PCAOB in August, updated their sort of description and disclosure of what those, what the auditor's report would now be, and gave some excellent examples for language. So if in case you want to double check your auditor's report, the PCAOB put out their report in, I think it was August 23rd of this past year. Nothing really different from the prior, but I think there's a little bit of tweaking. But the big thing that people are more concerned about is this concept of critical audit matters. And for large accelerated filers, it's really going to be hitting next year to report the year after that. So we're a bit in advance here. One of the reasons that we're bringing it up is that audit committees should still be thinking about this. They should start thinking about this and start talking to their auditors about it so they can prepare for what might be included, what that disclosure might look like. The whole goal here is to avoid surprises. You never ever want your board to actually look at a proxy statement in any year and suddenly be surprised as to its contents. So this is something that audit committees should be thinking about now. And so they understand kind of what the disclosure is going to look like when it comes up, so they can be prepared for it and potentially, address some of those matters now. So again, this is not a this year thing, but keep in mind as due to the inevitable expansion of reports, there is a growing trend toward more discussion of what the audit committee does, what its role is, et cetera. And that's been, that it continues to be a growing trend. There are a number of excellent examples out there, but because of critical audit matters, this may be something, if your board, if your audit committee is involved in this now, if you are if you are describing what they're doing, it may be useful to think about this so that, again, the description of what they're doing and how they're acting doesn't become stale. Because this is very dull, I'm just going to let you read it later. All right, so this one is kind of interesting. Mostly because it allows me to mention my absolute favorite piece of legislation that I think probably has no chance in passing, but it's the Stop Walmart Act. But my favorite part is the name of it. It's Stop Welfare for Any Large Monopoly Assessing Revenue from Taxpayers Act of 1918. Stop Walmart. I'm going to let you try to figure out how long it took a staffer to come up with the name of that, so it's spelled Walmart. But essentially, and this one is, you can't do any buybacks unless certain worker benefits are achieved. Now you can do other things with it, but it addresses stock buybacks. So, which is not really the point here, but it does lead you to the point of, with respect to tax reform, a number of companies have seen their effective tax rate go down. And one of the points here, and this is something that is worth noting to, in your 10K, is because your MD&A does need to talk about sort of known trends and uncertainties, the question really comes down to is, what does this mean to you? Does it, have a significant impact? If you know that you're going to be, taking this chunk of cash and you anticipate doing, X, Y, and Z with it, you're going to increase, benefits to your workers. If you're going to be using it for, to revamp your computer systems internally or whatever else, if you have specific plans that you already know about, then you should talk about how this changes your strategy, possibly what you're going to be doing with the cash. It may impact, as we noted on here on KPMG with respect to tax reform, there are things that should be considered when you're actually discussing it that flows through actually more than just one note on your effective tax rate. It can impact a wider variety of things like, liquidity, et cetera, like KPMG intergroup pricing arrangements. So that is something that really should be, sit down with finance to make sure that you have a good sense of what the impact of the Tax Reform Act is going to be. There was, just as you know, there was a grace period that allowed companies to use good faith estimates to adapt to the income tax effects. That grace period is ending. But I have no doubt that in and of itself is probably, and there's no sense that they're going to be extending that grace period. But nonetheless, because this does have a significant change that flows through a number of different places, this is something to bring up with your finance group early to make sure that it is adequately disclosed. Think about your MD&A, think about your liquidity and capital resources as you're going through. It may be a wonderful thing for you, but you may want to make sure everyone knows how wonderful or otherwise.
Yeah, good point. So we all know the SEC released some updated guidance on disclosure obligations with regard to cybersecurity risks and cyber incidents over the past year. And so really, the framework for disclosure on cybersecurity issues remains the same. There's a little bit of fleshing out and clarity that we can talk about later. There is a new focus on policies and procedures, and this is where a lot of the interesting discussion is happening. And so many of you may have heard of the situation at Google where there was a potential data exposure. They, like a lot of companies, have formed these internal cybersecurity disclosure committees to determine whether or not an incident is something that is sufficiently material to disclose, and then the timing of that disclosure. And in that situation, they said, well, the number of users were in the hundreds of thousands versus the millions. There's no clear evidence that the information was actually misappropriated and used, so we're not going to disclose it. And so that would be where the story would end, except that subsequently there was a leak of the internal memo that came to this decision. And so you can imagine what comes after that. Now there's derivative lawsuits, and general outrage that will probably last for a few days before we move on to the next cybersecurity incident. But having said that, there is a new focus within companies. So do you need an internal disclosure committee? And at what point does that committee actually need to reach out and get some independent advice as to whether or not disclosure is necessary? Turning back to the disclosure framework itself, and so the standard for disclosure remains materiality, as we mentioned, and, the legal framework is still very much the same as it always has been. I mean, is there a substantial likelihood that a reasonable investor would consider the information important in making an investment decision? And so when we're looking at materiality, we're looking at the nature, extent, and potential magnitude of the harm, the range of harm that the incidents could cause, including reputational, financial performance, and customer and vendor relationships. Those are all factors we need to take into account. Of course, omitted information may be material, and it's always a judgment call. The SEC was very careful to say that no company should feel obligated to disclose technical or compromising information as part of its process. And they may very well be reaching out to company counsel for analysis as to why a breach was not material. Perhaps just as important as the materiality of the disclosure, companies are really wrestling with the timing of the disclosure. And so once again, lots of judgment being used here. And what we can see from prior incidents is that there is a special emphasis on disclosure, particularly where there's a securities offering or another significant corporate event that's about to happen. So in those situations, the SEC is expecting appropriate and timely disclosure through an 8K. Obviously, you're not going to wait for your 10Q. And furthermore, and this is a little bit out of what we traditionally expect, companies have a duty to correct prior disclosure if it turns out the information is incorrect. And they have a duty to update that disclosure if it becomes materially inaccurate. And, this is really the SEC's acknowledgement that this area in particular, the nature of the risk, the magnitude of the risk, is changing day to day as companies find out more and more about a particular breach. And so I'm going to leave it there. We have a few more slides here about potential policies and procedures that may be impacted, as well as some useful benchmarking about, some board cybersecurity experience and how companies are governing these types of processes. And that's in there for you to take a look at later.
And then we saved the truly exciting until last, this InLine XBRL. The SEC did not adopt these rules this past year, but the compliance deadlines are fast approaching, so just be aware of that. For those who are uninitiated, InLine XBRL allows filers to embed financial data into the body of an SEC filing. When the exhibits will still be required to provide contextual information, and the XBRL website posting requirements were eliminated as of the effective date of the rule. And so here you can see on this slide there are the deadlines. A reminder on 10K cover pages. In connection with the smaller reporting company rulemaking that we discussed earlier, there has been a slight change. They have eliminated a parenthetical next to a non-accelerated filer. And also in connection with the InLine XBRL rulemaking, you can see that they have removed the references to website posting.
Okay, well, let's see. Do you want to ask for questions, or should we jump into the stock exchanges? Your call.
Yeah. Does anyone have questions? No. I think we jump into the stock exchange.
Here we go. Nicole? Is this one yours?
No.
All right, well, I'll do it since I'm here. So just to make it easier, so NASDAQ and the New York Stock Exchange both did some updates. The primary one, the one that was actually really quite useful, is that they amended the definition of market value for purposes of shareholder approval of private placement transactions. Because it used to be, it was an issuance of 20% or more at a price that's less than the lower of the closing price or the 5-day closing average. The New York Stock Exchange was a little worse, but then it eliminated, and then there was also the question of shareholder approval at issuances at a price less than book value. So in other words, what used to be a problem for clients, especially if their stock price has been declining, their book value could be significantly higher than their market value, which meant that they were tagged on this with respect to private placements, even if they were going to be selling at a price that was at a bit of a premium to the market value, because it was that book value issue. So the book value issue has now been eliminated, both for, it happened with the New York Stock Exchange, and then, it happened with NASDAQ. The New York Stock Exchange has proposed the same thing, effectively. And we're just waiting for the New York Stock Exchange one to get approved. There's really no doubt that it's going to, because it really does mirror what NASDAQ did. The New York Stock Exchange has also eliminated the requirement that listed companies provide the hard copies. This came out earlier this year. I think it's probably a relief to a lot of people. Here's the caveat: if you're a company that is not, required to provide everything in an Edgar filing, then you still have it. So it eliminates the requirement if the proxy materials are included in their entirety with the proxy card, which, by the way, is required with your 14A. And always has been, but it's always a good reminder, in an Edgar filing. Now, the New York Stock Exchange also has put out a proposal to essentially make a conforming change to its smaller reporting company definition. They used to refer to the $75 million market cap. They are amending that to conform just simply to the SEC definition. It's really just a conforming change because it allowed for certain exemptions for compensation committees and how they were structured. So they're just trying to make things consistent internally with the SEC rules. And that's what I had.
Yeah. Okay, well, thank you so much for joining us today. Have a happy holiday, and hey, just a reminder to sign in on the green sheets too. So, thank you.